Okay, hi everyone. Thanks for joining me here today for this session of an online webinar again. So my name is Ethan. I'm the education lead here in the IG Singapore office. So right now it is 7 o'clock. So once again, if you are traveling home from work or having your dinner at home, please just feel free to sit back and enjoy today's session with me. And of course, I understand that we also have viewers from the other regions as well. So a very good morning and a very good afternoon to all of you as well. And before we kickstart to today's session, right, I just want to do a very quick mic check to make sure that the technical side of things and the audio is working. If you are able to hear me, right, can I just encourage you to go to this question panel inside this GoToWebinar menu to type in a yes right now. Okay, thank you, thank you. I see a few yeses coming in. I believe that the audio should be working fine. Okay, so I'll just leave this next slide on for the next 10 seconds in case there are participants who are not able to hear me. They will need to change the audio output settings. Okay, so before we kick start on today's session, right, as always, I just wanted to highlight some of these disclaimers. As always, right, for our webinar sessions, right, if I happen to show any content that is or any views in my presentation deck, please do not treat them as trading or investment advice. As always, the session is always catered with an intention to be educational. So please don't treat any of those examples as trading advice or investment advice. Okay, and also please do your own due diligence before you place any trades. If you are unsure of the risk and cost involved, please refer to our risk disclosure statement and the risk fact sheet at ig.com/sg. All right, so just a little bit of background about myself. Once again, my name is Ethan and my email is below. And previously, I was from another local brokerage called Philip Futures, who has since rebranded to Philip Nova. So my background has always been in the brokerage industry. I was doing a little bit of business development and like an account manager back then. But right now here in IG, I'm focusing more on the educational side of things, meaning webinars, seminars, and other educational materials. And I just wanted to encourage those who did not locate the question box earlier, right, to try to ask questions as well as we move along today. Okay, so if you are shy, please do not worry because all the questions that you type into the question box is anonymous, so only I can see them. The other attendees today will not be able to see your questions. So please just feel free to help yourself as well to ask questions that you think that I can answer as well. So if not, then I will try my best to answer all the questions I received live today. If not, I can actually get back to you another time as well. All right, so for today's session, right, it's going to be a 1-hour session on identifying trading opportunities as well as scaling into your winners. So the first part of this session, we'll be talking about trend identification. We'll be talking about potential entry and exit strategies, as well as how we can actually use certain indicators to scale into the winning trades. Okay, so without further ado, I will just kickstart into the content today. Okay, so I think the first thing that we want to be very clear is that when it comes to trading, especially if you are trading leverage, before we happen to even execute any trade, right, we definitely need to have some form of strategy and an idea. Okay, and when it boils down to the execution, we definitely will need something what we call like a trade plan. And we have to be very clear on our risk, rewards, our entries and exit. Okay, but today I will just share a very simple trade setup and trading plan following this DEEP formula, DEEP meaning DEEP, and how we can enter into those potential trades. Okay, so these 4 letters can actually provide you with a general framework for your trade execution. And of course, you can always have your own trading strategy and trade plan. So please do not just follow this blindly. It doesn't work all the time as well, but at least it gives you a framework and a basis to execute your trades. Okay, so for a start, when we talk about leverage trading, definitely the first thing we want to do is to know what is the strategy. So when it comes to strategy, you need to know what is the market, the underlying market that you are trading, what are the conditions to execute your trade. So there are actually various strategies, such as you can be a trend following strategy, you can be doing a mean reversion strategy, and of course your trading style could be very short term, from scalping to swing trading to position trading, etc. And of course, you definitely need to consider something very important, which is the time frame of the trade. Okay, so the time frame for the trade differs for everyone, because, for example, if you are like me, you have a full-time job, you probably have no time to scalp the Asian sessions or even the UK sessions, the UK opening. You probably will only be able to look at the US sessions at night. So this is also something that you want to consider. And of course, if you are looking to trade very short term, then you'll definitely be looking like a 1 minute or 5 minute chart. But if you are looking to hold something in the longer term, let's say you're planning to hold a trade for a few days to a week, because you don't want to consistently monitor the 5 minute chart or the 1 minute chart, then probably you need to look at a higher time frame, potentially like the 15-minute chart or the hourly chart. Okay, and when you have a generic idea of what you want to do and you have a strategy in mind, right, then it boils down entirely to the execution of the strategy. So in the execution, what you need to have is what we call a trade plan. You need to be very clear of the direction. Okay, so direction meaning to say whether you are going long or short. So that's very straightforward. Whether you want to buy or sell, where is your entry price and where are your exits. So exits doesn't mean it is just your stop loss. It can also be in a form of where you take your profits as well. And of course, more importantly, is what we call the position size. So this position size aspect is on how you size your trade so that you don't exceed your risk parameters. So I'll share a little bit on a very simple technique as well on position sizing further down today. Okay. So the very first question, and of course the very first letter when we talk about DEEP, right? Direction, entry, exit, and position size. The first letter is D. Okay, so the question we want to ask ourselves right now will be, is there a prevailing trend? Okay, so when we look at the chart or when we look at the underlying markets, they are actually either in an uptrend or downtrend, or they could be in a consolidation phase, or we call them in a ranging state. Okay, so either uptrend, downtrend, or ranging. So the concept of identifying trends isn't too complicated. If we see higher lows, okay, so if you notice that the lows, right, every time it retraces the low, the price of this low is higher than the previous low, then we can actually say that the underlying market is in an uptrend. Okay, or if you see that the price of the highs is higher than the previous high, so meaning to say lower lows and lower highs, we can tell that it is in an uptrend. And I think the important concept that we want to have is that when you notice something like that in the charts, right, when the market is trading in an uptrend, what we want to potentially do is to look for long trades. Okay, so I repeat, in an uptrend, we want to look for buy positions or long entries, because if you think that this high price is potentially the peak, or you think that this price could be reversing soon, then you may want to follow another idea. Okay, so it can be another strategy, but today we are talking about a trend following strategy. So if it's in an uptrend, then definitely we want to follow the direction of the trend, which is to go long. Okay, so you can think of the general trend as like a river. If the river is going downstream, we want to swim along the river. We don't want to swim against the river, because that is the path of least resistance. If you are swimming against it, then it may be harder as well. Okay, so if the market is in an uptrend, we want to look for long positions. And of course, on the reverse, right, if there is an uptrend, then definitely there will also be a downtrend. So in a downtrend, what we want to do is to look for selling opportunities or short entries. Okay, so the question is that in the uptrend, we want to buy, right? In the downtrend, we want to sell. So again, it's the same theory, right? So nothing too complicated. We just want to follow the general direction of the trend. That's why this is called a trend following strategy. Okay, and the markets, other than uptrend or downtrend, they can also be ranging. So when the market is ranging, what it means is that the prices are trading within this stipulated support and resistance level. And of course, if it's ranging, it doesn't mean that we cannot trade, because if we believe that this range will hold, right, this resistance and support will hold prices well, then of course we can also trade these opportunities that's presented to us, right? So what we can do is that we can try to enter a short position at the resistance and buy at support. So this is nothing too complex if you believe that this range will hold. Okay, but today we won't be covering any range trading strategy, because previously in our super trend webinar, that is something that we have already covered. Okay, which is by the use of two very simple indicators, the Bollinger Bands and the stochastic oscillator. We have this setup whereby if prices break out of the stochastics band on to the resistance side, right? And we notice that the stochastics is showing an overbought level, and that is where we can potentially do like a mean reversion strategy, whereby we do a short position. Okay, so that was something that was covered in our earlier sessions, but today we'll just look at a very simple, a very easy to understand, and a very applicable trend trading strategy. Okay, so this is the first letter D, the D part of DEEP, where we try to find a directional bias, and that is actually step number 1. Okay, but to find the directional bias, right, what we can do is that we can use indicators here. Okay, so one indicator to identify trend, of course, would be to use the moving average line. Okay, what we saw earlier in the charts, right, were very obvious examples, right? Because in hindsight, when you look at the chart, you notice that there is lower low, lower highs is definitely in an uptrend. But sometimes you notice that when you're looking at the particular chart, okay, it can be a 5-minute chart, it can be a 15 minutes chart, an hourly chart, a daily chart, a weekly chart. Sometimes when you look at the chart, right, it may be a little bit tough to even think whether you should go long or you should go short. Okay, so it may be hard to decide if you look at the chart and without the use of any indicators at all. So what we can do is that we can use indicators to help us make these decisions, whether we should buy or sell right now. Okay, so when we talk about moving averages, right, this is a fairly straightforward tool. Okay, and when we talk about moving averages, there are actually two very popular ones, which is the simple moving average, or what we call the SMA, and the other one is called the EMA. Okay, so the simple moving average is basically the average closing price over a specific period. So let's say in the trading platform, if you happen to indicate a period of 50 on a daily chart, so what you see is this line that is drawn in the candlesticks, right? So within all these candlesticks, you see that there is a line showing you what is the average closing price for the past 50 days. Okay, so if you're using a 50 SMA, that's the average closing price for the last 50 days. If you're using the 50 SMA on a 5-minute chart, right? So that is the average price for the last 50 candles of the 5-minute chart. Okay, so that's the average price for the last 250 minutes per se. Okay, so the other moving average very popularly used in the world of trading is what we call the exponential moving average, or the EMA. Okay, so it's a little bit different from the simple moving average, because this time, right, when we are looking at the EMA, there is a little bit more weight and relevance to the recent price. So if you notice the line, right, it is a bit more reactive. If you notice, let's say if we talk about Bitcoin or even Ethereum, recently there is this huge rally, right? So you notice that the SMA will be a smoother line, but the EMA will react better towards the more recent prices as compared to the SMA. But of course, there are also many other indicators for you to identify trends. You can also use indicators such as the parabolic SAR, there is the super trend, there is the Ichimoku cloud, just to name a few. But today we will just be focusing on the simplest one, that is the moving average. Okay, so just let me off my pointer here real quick, because I realized that when I on the pointer, right, I'm unable to actually see the questions. So just let me try to disable this pointer right here. Okay, so let me take a look at the questions just a second. Cannot see line. Okay, so haven't drawn the line, so just a second. All right, so let me move on to the next slide. Okay, so if we add in the exponential moving average indicator to the chart, right? So what you're seeing here is the daily chart. If you look at the top left-hand corner of the chart, you see there is this daily wording over here. So this is the daily chart, and when we add in the exponential moving average, and the settings that I'm using here, if you look at the bottom left, is 20, 50, 100, and 200. Okay, so you notice the bottom left hand of the chart, there is a number with a color. The blue is 20, the purple is 50, the yellow is 100, and the orange is 200. Okay, so how we use this moving average line is that if you notice the current price is actually above the 200 line. So based on this chart, right, the dollar yen previously, the screenshot that I took previously. So if you notice this particular chart, the daily chart for the dollar yen, right, if the price is above the 200 EMA, I'm using the exponential moving average. So when the price is above the EMA, right, we try to have what we call like a bullish bias. So when we have a bullish bias, what we want to do is that we want to look for buying opportunities, or we want to look for long entries. Okay, and when it's trending strongly in a certain direction, right, you notice that the moving averages, the lines, right, they are also stacked nicely with the faster moving average being on top and the slower moving average being at the bottom. So in this particular example, right, you notice that the 20 is on top, the 50 is below the 20, the 100 is below the 50, and the 200 is below the 100. So when all these moving averages are stacked nicely like that, right, you can tell that this is actually a very nice uptrend. Okay, but one thing to take note is that sometimes when the prices retrace in the short term, right, you may notice that the faster moving average, example the 20 or the 50, right, they can actually crisscross each other. So you may see that the lines are not entirely stacked up nicely. Sometimes the lines cross each other, but that is totally fine. Okay, so in this particular trend following setup, we will just focus on the 200 exponential moving average. And if the prices is above the 200 EMA, then we want to actually try to look for long opportunities. And again, if the prices is trading below the 200 EMA, then potentially what we may want to do is to look for selling or short opportunities. Okay. So this chart here is just showing the reverse, right? So you notice that on the left-hand side of the chart, previously it was a very nice uptrend with the faster moving averages stacking up very nicely on top of the slower moving averages. And the prices have started to break the 20, 50, 100, and 200. Essentially, once it broke the 200, it started to turn bearish and it became kind of like a downtrend, right? And you notice that the moving averages, right, the average price, the line starts to stack nicely again. But this time, instead of stacking nicely above, right, it stacks below. So you notice that the short-term moving average is closer to the price, is the 20, and 50 is above acts as a dynamic resistance, and then followed by the 100 and 200. So this time, instead of it stacking nicely with the faster one on top, it is the reverse on the downside. Okay, and one way you can look at moving average is also that the average price, right, over a certain period, it also acts as a dynamic resistance or a dynamic support depending on whether the price is on top or below. If price is on top of the moving average, then the moving average is potentially a support level. And this support level is not fixed because as prices progress, right, as the market continues to trade, right, you notice that the moving average reacts according to the prices as well. So it's not a straight line, it is not a zone. It is actually a very smooth line that is reflecting the average price. So this moving average can also be treated as a dynamic support or resistance level. Okay, so these are just two very obvious examples of uptrend and downtrend. Okay, so when we look at this particular chart, okay, because sometimes if we don't add in any of these indicators, right, imagine right now if you look at this chart, it may be a little bit hard to for us to determine a bias. So if we are looking at this alone, do you think you should go long or you should go short, or you should stay away? Are we able to determine if there is any trend just by looking at this? Okay, so you can just type your answers in the question box right now. So I will just take a look at your views on this chart. Okay, so for those of you who have not typed in anything in the question box, I encourage you to try to locate this section, so you can also ask questions along the way. Okay, so do you think it's an uptrend? If you think it's an uptrend, type uptrend. If you think it's a downtrend, type downtrend. Okay, so I see a little bit of mixed view. So some said they are not sure. Some said it's downtrend. Some cannot see the trend. There's some still saying it's uptrend. Okay, so right now it could be a bit difficult to see. But right now, if you add in the moving average indicator to the chart, right? Okay, over here you see. So this is the same chart, but we add in the lines, right? So previously, you notice what happens here is that on the left-hand side of the chart, prices were in an uptrend because why? Higher lows and higher highs. And of course, prices were trading above the orange line. And the orange line that we are seeing right here is the 200-week EMA. So you notice that on the top left-hand corner of this chart, right, there is this weekly wording. So every candle that we see right here is one full week of price action. So this is a very long-term view. So this is a long-term view of the spot gold. So over here, you notice that this is the weekly chart. Okay, notice that the price here is not that accurate, so because it was taken a while back ago, just to share with you the concepts. Okay, so you notice that in an uptrend, right, earlier when the weekly gold chart was trading in an uptrend, you notice that the 50 EMA, the purple line, was acting as a support because the prices bounced off the 50, right? And then it went up, it went down to the 50 again, but it broke the 50 EMA. It went to test the middle yellow line, which is the 100 EMA. It got supported a little bit here and there. It went up again, it went down again to the 200, broke the 200, and right now prices are trading below the 200 EMA. Okay, so from this, right, when prices break below the 200 EMA, right, so if we look at this chart alone, if prices are trading below the 200 EMA, then the bias that I will have will be a bearish bias. Okay, so this would be the if you look at the higher time frame, so we look at a bird's eye view, right, on the gold prices back then. Okay, so back then, if you look at gold prices, you will have a bearish view over here. And if we look at the shorter term, okay, so previously it was a weekly chart, right? So from a higher time frame perspective, the bias is a downtrend bias. We are looking for sell entries, but we don't exactly we don't exactly do a short position at the weekly chart. We zoom into a lower time frame. Okay, so using a multi time frame analysis right now, we look at the daily chart. Okay, and when we zoom into the daily chart, right, again, the exponential moving average, right, you can use it to determine as a mid-term trend as well. Okay, and when we want to enter a short position, then these lines over here, right, can actually be used as entry signals as well. So how you can use this now is that when you understand that in the higher time frame, right, the higher time frame or the higher perspective trend is in a downtrend. In a downtrend, we are looking for selling opportunities. If we zoom into the daily chart to look for these selling opportunities, right, what we want to do is that we want to sell when the price is retracing to a certain support level. Okay, so we don't just sell at a market order, meaning to say that if it's a downtrend, we sell immediately without any confirmation, without a good price. So what we're waiting for is that we are waiting for price to retrace up to this exponential moving average level, because we are treating these levels as either a support level if price is above, and if it's in an uptrend, then you can use the EMA as a good retracement support, right? A support level to enter a buy trade. But right now, since the weekly chart, we have this bias of a bearish bias, right? We are looking for selling opportunities. When we zoom into the daily chart, what we are trying to find here is a resistance level to short. Okay, And to identify this resistance level, one way, of course, you can draw your horizontal lines. That one you have to identify them yourself. You have to scroll left on the chart. And of course, different people may identify different resistance level because everyone is different, right? Everyone sees a little bit differently. And of course, if the resistance level or support level, if it is obvious enough, then it would be even stronger level. But sometimes it is not that obvious. And of course, we can again use the exponential moving average as a dynamic support resistance level for our entry. So in this example, you notice that the weekly chart earlier has broke below the 200 EMA already. So we want to adopt this bearish bias. So in the daily time frame, we want to look for selling opportunities. And right now, if you notice this particular screenshot over here, right, prices is currently testing the 100-day exponential moving average. Okay, so what you want to do here is that this could again be a potential short entry. Okay, so this could be your first entry to take a short position in the longer time frame of a downtrend. Okay, so that's the first way. All right. So of course, another tool that other than the moving average, right, is that we can, to better time our entries, would be to use the Fibonacci retracement as well. So what you can do is that you always draw the Fibonacci retracement, be it an uptrend or a downtrend, you draw it from the left to the right. Okay, so don't draw it from the right to the left, always from the left-hand side of the chart to the right-hand side of the chart. Okay, so you want to identify a previous swing high and a previous swing low. So once you identify these two key levels, right, a high and a low, you connect the lines, you drag the Fibonacci retracement drawing to the right. You notice that there are actually some of these key levels that you can actually look out for. Okay, so 3 key levels particularly that I like to look out for is, you can think of it as the midpoint, which is the 50% retracement level, and +1 up and -1 down. Okay, so 50% +1 up is 61.8% retracement level. -1 from the 50% is the 38.2. So you can look at the midpoint and the levels that is 1 up and 1 down. So if you notice right now, based on this screenshot, right, the gold price was actually being resisted at the 61.8% Fibonacci retracement level as well. Right, so this is another way. Let's say if you are not using the exponential moving average, you are a firm believer of Fibonacci retracement levels, then this is something that you can actually use as well. So you draw from a swing high to a swing low and look at how prices react to these levels. Okay, so you don't predict, you look at how they react to these levels instead of predicting. But of course, if you happen to find some form of confluence, right? Confluence meaning to say both the Fibonacci levels and the exponential moving average, right? Both of these are actually showing some form of resistance at a very similar level. If that happens, right, then you will gain more confidence in your entry, because that is when you have the belief that it is not that easy to break this level, because the traders that are looking at the EMA may try to find short positions when it reaches, in this example, the 100-day moving exponential moving average. And of course, the people that's looking at the Fibonacci retracement, this particular level is also at the 61.8% level. Okay, so of course, if you happen to find that there is some form of confluence, right, then it gives you more confidence, it gives you a higher conviction to enter into this trade. Okay, and when we talk about entering a sell position here, right, you need to also be very clear on your risk parameters. Okay, so if I happen to enter a short position here, where do you think is a good level for you to enter your stop loss? Okay, you can just type it in the chat or the question box. Okay, very good. So Alex was saying that there is a good level to place your stop loss is the 200 EMA. Okay, so I think that is very applicable as well. If you are looking left on the chart, if there is a very obvious resistance, a horizontal resistance, definitely you can reference to that point and place your stop loss just slightly above that resistance. But if not, then a good way is to actually just reference the orange line here, which is the 200 EMA, and add in a stop loss just above the 200 EMA. But of course, another way that you can use is also other tools such as the average true range that measures the average volatility. And what you can do is that you can take a 1 times ATR, a 1 times average true range, or 2 times ATR, and add that on top of your entry. Or if you want to be very safe, right, you can even take 1 times ATR or 2 times ATR and add it on top to the 200 EMA. But just be very mindful that the wider your entry and your stop loss level, right, the amount of risk you're taking is, if you're taking a higher risk parameter, right, then you need to consider your take profit level as well. If you're taking so much risk, how much profits are you looking to actually generate from this particular entry? Okay, so even before you enter this short trade, just try to think of it as your whole trade plan. If I'm going to short here, I don't want to just short without knowing where are my exits. Okay, so potentially I may want to have my stop loss above this orange line, which is the 200 EMA, and my take profits, if I don't have a level, of course the level could be this low, right, at the 0% here, which is the previous swing low. Or if you want to do you want to capture a longer term trend, right? You can what you can do is you can use the trading stop loss. Okay, so how the trading stop loss works is that as you get your initial entry right? So initially you have an entry, a sell entry over here. Since your entry is a sell position, right, your stop loss will be higher than your sell entry. And what happens is that if this stop loss you're putting above your sell entry is a trading stop, as you get your entry right and prices happen to keep on going downwards, right, you notice that this stop loss keeps on adjusting itself towards the direction of the trend as well. So what happens here is that your stop loss, instead of becoming a trade that will close out your position and take a loss, right, it becomes a take profit mechanism as well. So instead of your stop loss becoming a mechanism for you to cut losses and lose money, right, now it becomes a mechanism for you to lock in your profits, and it follows the trend as well. So this is an automatic adjustment. Okay, so you don't have to manually do it. It adjusts automatically. But of course, if you have manually key in a stop loss level, you still can manually amend it as the market trends in your favor. Okay, so the idea that I want to share with you is that there isn't a foolproof way. Even all these trend trading strategies, or if you go online and you happen to hear from other trainers or other educators on certain strategies, I just want to say that there is no 100% guarantee in any of these trend following strategies, any of these mean reversion strategies. It is always just a probability thing. Okay, so the market is always still random, and what we want to try to do is that we don't want to predict the market so much. We want to react to how the prices are currently trading. So if we think that prices is actually reacting to this particular moving average, and our view is that we want to take a short position, then we need to be very clear on our exits as well. If we take a short entry right now, where do we want to cut our loss, and where do we want to take our profits? Okay, so it's not so much about prediction, it is more about being prepared and reacting to prices. Okay, so even if prices did not reach this level, what you can do is that you can also react by placing sell orders here already. Because even before the recent prices, sorry, just let me on back the pointer so it is a bit clearer. Just a second. Okay, so even before the prices is showing over here, right, even before this price is formed, you have already identified the previous swing high and the swing low. Okay, so once you identified these 2 points, right, you notice that even before price is formed over here, you already have all these key Fibonacci levels. So if you notice that if you think that the 61.8, right, even because before the prices form here, right, this EMA line wouldn't be drawn. Okay, so you won't see this line over here. But if you think that prices are starting to consolidate around the 50%, and it is close to the 50 EMA, that is potentially the first entry you may want to take, a small entry. And it happens to break and it tests the 100 EMA, then that is potentially the second entry. Okay, so that is how you may want to consider scaling your trades as well. So one thing to take note is that when you're entering your trades, you may not want to also fully enter a very big trade at one price level. You may want to split your risk, right, into maybe 4 different different slices of pizza, right? So imagine you have one pizza, you split them into 4 portions, and if there's an opportunity coming up, just trade a small bit first, and then if there is there's another opportunity, then you enter another small bit. Okay. All right, so another indicator we can use to help time our entries would be the relative strength index, or better known as the RSI. Okay, so the RSI is actually a momentum indicator that measures the magnitude of the recent price changes. So what it does is that it shows you what is if the current market price is overbought or oversold. Okay, so if it's overbought, right, it means that this RSI indicator over here, this will be below your chart. If you right click on the trading platform, you go to indicators, you click on RSI, this will form below the chart. You won't see this at the price level. And if you notice that there are two lines already drawn, the 30 level and the 70 level. So if this RSI indicator, right, this RSI is showing this red zone, okay, so it's above 70, this means that the prices are overbought. So to give you some context, right, RSI basically how they count this level, right, is they are using the average gain within a certain period over the average losses. Okay, so what this means is that if the RSI is trending up, it means that the average gains within these periods are greater than the average losses, which also translate that there are more bullish candles than bearish candles. And if the RSI is going down, it means that the average losses within a given period is greater than the average gains. Okay, so the period is determined by yourself. You can actually indicate that in the indicator. So what it does is that it measures the momentum, right, as well. Because if the bullish candles, right, are forming too quickly, okay, so within a short time frame, you notice that prices keep going up. The average gains is compared to the average losses is way too high and way too fast. Then it will tell you that potentially prices could be already in an overbought condition. And when the RSI is showing an overbought condition, the general idea is that this is a sell entry. Of course, there are some techniques is that there are some of the traders, they are looking for RSI to cross below the 70. So they don't trade in the overbought condition. They wait for price, this RSI to cross below, back to below 70. Then that is where they execute their sell trade as well. Okay, so there are various ways to look at this indicator, but of course for today, right, we are looking at the most general and the simplest way to look at it is that if prices are above the 70 line, we look for selling opportunities. If prices have gone below beyond this 30 line, right, and it's showing a green area, right, then that is where we want to look for buying opportunities. Okay, so how can we use this indicator is that we can use it as a secondary confirmation. Okay, so we don't just look at the chart alone and just look at this indicator. We still look at the EMA levels, we still look at the Fibonacci levels, and this is just a secondary confirmation. Okay, so in this particular example, right, if you look at this chart, right, you notice that this is a 15-minute chart on the Russell 2000. So example, if you notice that prices are actually being supported at the EMA lines, right? So you notice that it was supported at this 200 EMA. There was a false break beyond, it went back up. There was some support at the 100 EMA as well. Then it tested the 200 EMA again. It went back up and then it tested the 100 again. Okay, so over here, of course, it was supported by the 20 and 50. But in this particular example, right, what we want to do is that we want to wait for prices to retrace to all these lines before we look at a buy entry, right? But to better time our entries, rather than just looking at this exponential moving average line alone, now we look at this bottom part. We look at the RSI indicator as well. Okay, so if you look at the RSI, you notice that as prices retrace, right, there are only certain points whereby the RSI is touching the 30 level. Okay, so these are levels that can potentially gives you like a secondary confirmation, because it shares with you that previously the average gains over here is quite huge, right? But over here the RSI is showing oversold, which means that within this particular recent prices, the prices went down too quickly. The average losses compared to the average gains was too fast compared to historically. Okay, so when it's too fast and it went to an oversold condition, this is when paired up with the trend following strategy using the exponential moving average, these could be potential levels that we may want to look out for. First level, we look at when price retraces back to the EMA. Second level, we look at whether the RSI as a secondary confirmation, is it in an oversold condition? So we can actually look for a confirmation for a buy entry. Okay, so another example we have here is that the prices, right, it is in an uptrend over here, it's tested the MA. But over here, you notice that for this portion, right, this particular area in an uptrend, right, you may not be able to catch this. But if it happens to retrace and starts to test, let's say over here, this is the 100 EMA level. And you notice that right now, prices is the RSI is also showing an oversold condition. This could be a potential buy entry. Okay, so again, the stop loss level, you can add it below the 200 EMA, or again, you can use the average true range as a reference point. You can add a 1-time ATR, a 2-time ATR below your entry or below the 200 EMA. And for your profit taking, right, how to exit your trades to capture your profits, you can look left, look at previous highs, or if you are doing, again, this trend following strategy, usually what I encourage you to do is to use a trailing stop. Okay, so that as prices moves up, if you get the trend, if you get the direction correct, right, and if your initial view was correct, then this stop loss will actually be shifting to the upside and eventually become a take profit level. Okay, so for the next part, we'll be looking at the P. Okay, so far, if you recall the DEEP, right, the 4 letters for this trade plan, the D being the direction. Direction we covered using the 200 EMA. We have the entry and exit. Okay, so entry we covered the EMA as a dynamic support for an uptrend, a dynamic resistance in a downtrend. So we can look for potential buy or sell entries using the EMA lines as reference point. We talk about Fibonacci retracement levels as potential support or resistance as well. We talk about the RSI indicator as a secondary confirmation. But of course, you can also look without indicators, right? You also can look at chart or candlestick patterns as well. So if you are trading long enough, sometimes you recognize certain chart patterns or certain candlestick patterns. So without the use of indicators, you can also use these patterns to help you make your to further strengthen your entry conditions as well. Okay, but the next part and the last letter from DEEP, right? The last part is what we call the position size. And position size is important because instead of managing your risk using, let's say, a notional amount, example, I'm just going to risk based on my entry and exit at this level, I'm going to risk $200. So if I'm risking $200, do I need to keep my stop loss to a more stringent level? Or $200, if $200 is this a huge budget that I can actually increase the distance of my stop loss? Okay, so that's not how you plan your trades, because the stop loss, right, should be a level that is not influenced by your account balance or things like that. That should be the fundamental of your trading strategy or the fundamental of your trading idea and trade plan. So the position size comes in to calculate what is the trade size for you to execute your trade based on your initial idea. Okay, so the first step to calculate this P is how big of a trade to enter. And if you look at a very simple idea or concept that I usually share, is what we call a 2% rule. So the 2% rule states that the maximum loss per trade should be kept to 2% of your account equity. And very simply, if you look at this table, this 2%, of course, is based on your account size. If you have a bigger account size, you notice that you can actually risk a bigger amount. But of course, even if you have a small account size, it doesn't mean that you should just enter one trade and risk the whole $1,000. You should still have instill this discipline in you to try to keep the losses to a minimum. Okay, so if you have this discipline to always ensure that your trade plan has this has this risk parameter that's within at least 2%, you will ensure that your trading account has more longevity. Okay, especially if your trading account, if you imagine if it's a $100,000 account and you're risking 2%, which is $2,000 per trade, you may also think that $2,000 risk per trade could be a big amount. Furthermore, if you have a $500,000 account or $1 million trading account, then would you even use 2%? You could even be risking, let's say 1% or even lesser than 1%, right? So 2% is not a fixed amount. It is just a general idea, a general guideline for you to have conceptually to try to have something, a framework to stick to. But for a start, let's say if you have a smaller account size, I will still encourage you to not go beyond 2%, to still try to stick to 2%. Okay, so when we calculate position size, the step number one is to still apply 2% to your account size. You will be able to calculate what is the maximum loss that you can stomach for this particular trade. And the second step, of course, is what we covered earlier, the DEE, your entry and your exits. Okay, so the direction, entry, and exit, of course, that will be your trade plan. And the last one, the last letter P, right, is when we calculate. Once we have our entry level, once we know where is our stop loss, that is when we can calculate what is the correct size for this particular trade. So when we talk about position size for step 2, right, if you notice, if you are new to IG, this is actually the web-based trading platform. This is the deal or order ticket. It looks very similar. But of course, if you are trading on our mobile application, it is something similar as well. You will see similar fields, a buy and sell, size, a price level, and your your risk parameters, your stop loss and your take profit. Okay, so the D direction, are you looking to go long or short? Of course, this is very straightforward. It's either a buy or a sell. Your entry, at what price do you enter into this position, right? So if you have an idea to go long, you don't go long immediately. Because why? We shared that we look at certain key levels. It can be the exponential moving average. It can be a Fibonacci retracement level. We use a secondary confirmation. It can be candlestick pattern. It can be the RSI indicator as well. So this is where we key in the price level, right? So at what level do we buy or at what level do we sell? And of course, we look at the exits as well. So exits, we look at where is the stop loss, where do we cut loss, is over here. And we also look at where to take profits over here. Okay, so this is actually the first three letters, the D, E, E. And the last letter, the P, right? How big of a trade do I enter? So for P, right, what you want to do is that this will be the last step before you execute the trade. So P is over here where we talk about the size of your contract. So before you even think about what is the contract size, you already need to be very sure of your direction, your levels. Okay, so after you key in all these details, then the last portion is the size. How big of a trade do I enter? Okay. And just to give you a very quick example, because I noticed right now it's about 7:50, so we are running out of time already. So I'll just give a very quick example over here. Okay, so if you, based on your own, it could be a technical analysis or fundamental analysis, you are looking to actually buy Tesla shares. So probably you look at the charts, you have a bullish view. And what you want is that you think that the current price at $170 is maybe at a support EMA, let's say 100. You think that this is a level you can enter a buy entry. And from the chart, you may already have a profit target, because maybe you look left, you think that this is a level that you can take profit. And you can probably already know that where is the level you want to cut your loss. Okay, so you can actually reference the, let's say the 200 EMA, or you can use the average true range as a guideline. And you know that your trading account right now is a $10,000 account. So step number one will be to be very mindful of the amount of money you can lose based on your account size. So based on a $10,000 account, based on this 2% rule guideline, I know that 2% multiplied by 10,000, I can risk $200 for this trade. Secondly, what is your trade plan? So think about the DEP again. So what is my entry price? What is my stop loss level? What is my take profit? So over here, if you have already those levels in your mind, you know that your entry is $170. The take profit is, let's say, at about 178.5. The stop loss is about 166.6. You are very clear on these levels. Step 3, then we calculate what is the right sizing. Okay, so to calculate the right sizing, you need to know what is the maximum amount you can lose divided by the risk per share. In this case, it's Tesla. The risk per share is 340. So if we take $200, we divide by 340, the risk we are taking per unit, we know that we can actually enter a 58 shares contract. Okay, so you don't have to exactly memorize this, because one very easy way to do this on our trading platform is that you leave this size empty first. So you leave it as blank. You put in your price level, you put in your stop loss, you put in your take profit. You notice that under the stop loss, right, there is this level here. So if you put 340 per share, which is 340 points, you notice that Tesla will be trading at 166.6. So it shows you over here in the trade ticket as well, 166.6. There is this slash over here, and it shows you the amount that you are potentially losing over here if your stop loss is being triggered. So if this amount is too far away from 200, because you need to do this 200 already, so you need to be very mindful of this figure in the first place. So this one, the platform won't show you, right? Because we don't know how much you want to risk. You need to calculate it on your own. But once you know your risk tolerance is $200 for this trade, you can click on the up or down arrow over here at this size. If you click on up, right? If you keep clicking on up, you notice that this figure will keep on increasing. And if it goes beyond $200, that is when you know that your trade has already exceeded your 2% rule. So what you want to do is that you want to click down again to make sure that this number is showing a number that is within your risk tolerance. Okay. So that's how you calculate your position size. Okay, so just a very quick recap of the setup. We talked about the first D, right? Direction, identifying uptrend or downtrend. We talk about the entry. Okay, so entry, we can wait for retracement to either the 20, 50, 100 or 200 exponential moving average or key Fibonacci levels. Best is if there is some form of confluence with, between the Fibonacci levels and the EMA. But of course, we can also use the RSI as a secondary confirmation or even candlestick patterns. We talk about our exits, right? So exits can be either a support resistance level, it can be a moving average level. You can also use other indicators like the average true range. And we talk about the position size to keep it below 2% of your account size. Okay. But again, when you are trading, right, the reality is that it is not so simple. Right? If it's so simple, right, then nobody will be working full-time jobs, right? Everybody will just be sitting on their computer and trading because the markets is random. You have to accept the fact that this is still a probability game. So all you can do is that you can try to find higher probability entries. Okay. So you notice that when you are trying to trade trends, right, there could be a lot of frustration because what happens when you're trying to trade trends is that there's a lot of waiting, right? There isn't the opportunities isn't so obvious. You have to wait for prices to pull back, right? Because if you are trying to trade trends when the trend is just forming at the very early or the very initial stage, right, then you are not trading pullbacks. You're probably trading something like a breakout strategy. Okay. And let's say if you are adding in certain conditions for your entry, if you are looking at the EMA, the Fibonacci levels, and the RSI. So assuming, let's say you have a rule A, rule B, and rule C, you want to make sure that all these three conditions are fulfilled before you enter a trade. If that happens, you notice that then you find that there is lesser opportunities because as you include more rules to your entries, right? You notice that the opportunities get lesser and lesser. But once you notice that if the three conditions are fulfilled, right, then usually you think that you have this confidence that, okay, then this is potentially a higher probability setup. Okay, rather than you just buy right now or sell right now without any framework or any concept. If you look at certain indicators, right, then that is when you will find that these setups actually there is a higher probability, a higher chance for you to profit. Okay, so the last frustration is that if you're looking to trade trends, right, as you're waiting for pullback, sometimes the market may not even have this retracement, right? Because if the trend is very strong, if it's in a very strong uptrend or a very strong downtrend, the retracement is very minimal. It may not even touch the 50 EMA level. And you notice that the RSI is always consistently in an oversold condition, right? So you notice that these rules are very hard to apply as well because the markets didn't pull back. There is no retracement. It doesn't even test the previous average prices. And the RSI is always constantly in the opposite direction, in an overbought condition, in an uptrend, right? So what can you do, right, is that to find more opportunities, right, you may need to trade breakouts, okay? And before trends are formed, right, you need to understand that before the prices can create a higher low and higher high, right, it definitely needs to break out from its previous downtrend or its previous consolidation. Okay, so if you want to catch the very start of the uptrend, is the hardest part, right? Because prices could be ranging and you may think that prices will continue to range. So if you want to be in the early stage of the trend, then definitely you need to look at breakout trading. But for today, right, instead of using breakout as your initial entry, I'm going to share with you the last portion of this webinar, which is to use breakout to scale in more trades. Okay. And of course, you can also use this Donchian channel, this indicator, to manage your risk as well. Okay, so when I say using this as to scale in your winners, right? What I mean is that to use this indicator only after you find an initial entry, meaning to say you already have a live position that is in the green. So example, you identify a higher time frame uptrend. Okay, so you zoom into example, you look at the weekly chart. The weekly chart is showing an uptrend. Prices is above the 200 EMA, which is the 200 week average price. So you zoom into the daily chart and you're trying to look for a swing trade, or maybe a trade to hold for 2 months, example, or you look at the daily chart. And in the daily chart, you notice that there is this pullback to this support level. And this support level coincides with, let's say, the Fibo level, Fibo retracement level, the EMA level, and RSI is showing oversold condition. So you entered a buy trade. Okay, so as you entered the buy trade, right, indeed the trend continued to go upwards, right? And your trade right now is in profits. Okay, so as you are holding this trade and riding the profits, right, is there any other way to continue to add in more trades? Okay, so if prices didn't retrace, right, then is there any other ways? Okay, so this is what I mean by how you can scale in your winners. When you already have an existing trade, how you can use this very simple setup to enter more trades. Okay, so this next indicator that we are going to use will be what we call the Donchian channel. So when you add this Donchian channel into the chart, right, you notice that there are 3 lines appearing. There is this upper band, there is this middle band, and there is this lower band. So it looks very similar to the Bollinger Bands, but the calculation is different because Bollinger Bands is using a standard deviation. For this Donchian channel is even easier. It's using the 20-day high and 20-day low. Of course, the 20-day high and low is it depends on the time frame of your chart. If I'm on a daily chart and I key in 20 as the period, this lines is showing me what is the highs for the last 20 day and the lows for the last 20 day. The middle line is actually just showing the average, which is the top line plus the bottom line divided by 2. Essentially, this is just a midpoint. Okay. So in this example, if I put in 20 in the period, and this is the daily chart, right? So this is the 20-day high, 20-day low, 20-day high, 20-day low, and the average of these two, the midpoint. Okay, and of course, this indicator can also be used as a trend filter. So for example, over here, let's say if I adjust the filter to 200, here over here, if you notice that if you change it to 200 on the 4 hours chart, so what it means is that the upper band over here, right, this light blue line on top is showing the highs for the last 200 candles on the 4-hour chart. And this line here is showing the lows for the last 200 candles. Okay, so how you read this is that this blue line here, right, is just showing during when prices were trading here, this is the low for the last 200 candles. Prices were trading over here, this means that this was the high for the last 200 candles. Okay, so quite easy to understand, right? It's nothing too complicated. And sometimes you can also try to use this as an additional trend filter. So meaning to say that if prices are trading above the midpoint or mid price, that is where you try to find long entries. If it's below, you try to find sell entries. But just be very careful of one thing is that for this Donchian channel, right, if you notice the prices are hugging the top or hugging the bottom line, right, just be very mindful not to go the opposite direction, because sometimes the price can hug the upper bands for very long. Okay, so if you think that the price has reached the 200 period high, it is time for the price to reverse. In this trend following strategy, that is not the belief, because we believe that the trend will continue upwards. We believe that if it's in an uptrend, we don't want to sell. We want to look for buying opportunities. Okay, so now I'm going to share with you how you can scale in your trades using this indicator called the Donchian channel. Again, this one is when you already have an existing position that you're making money. This is how you can further scale in. So one way is that you can actually go more long positions, right, to add in more long entries. as you notice this Donchian channel, right, it creates this upline. Okay, so previously we were trading at this high, right? This was the 200 period on the 4-hour chart, the high here. You notice that there is this uptick over here. This means that this price here is already breaking new highs, and then it went down, right? But this is still the high, right? For the last 200 period, it started to go up again. It went down again, but this is the new high. It went up. This is the new high. It went up. This is the new high. Okay, so if you look at this indicator, right, when it plots a new vertical line up and it's showing a new high, that is a potential entry. Okay, so you may not want to enter a full trade. You may want to enter a smaller trade right now, because what your belief is that this is kind of like a breakout trading strategy. So what you want to do here is that instead of going in a full trade, you want to go into bite-sized smaller trades to continue to ride the trend, so that your initial position that is already making money, you can be using those profits to enter even more smaller positions, right? To continue to ride the trend, so that if you are right again, right, then you will get more profits. But of course, if you are wrong, you can keep the losses to a very minimal level. Okay. So again, if the price touches the upper band, that means that it has broken out of the 200 period high. Okay, so if there's this uptick here, it means that prices have broken out. So these levels here are potential entry levels. Okay, so it allows you to actually find more opportunities to scale in to your already holding long entries. And of course, you want to trail your stop loss to ride bigger trends, which I'm going to share on the next slide on how to do that. Okay, so how can you cut your loss? You can also use Donchian channel to cut your loss. So earlier when we talk about entries, right, you notice that this band, right, this upper and lower band is very wide. Okay, because we are using a very huge period. Okay, so if we are using a huge period, when prices break above this longer term average highs, right, or average lows, right, then you notice that it could be a stronger signal to signify that there is more buying pressure or selling pressure. But when we want to cut our loss, when we talk about cutting our losses, right, we don't want to look at such a huge bandwidth. We want to keep the bandwidth to a very bare minimum amount, a very tight range. Okay, so when we talk about cutting our losses, what we can do is that we can now adjust the period to 20. Okay, so initially our entry is based on the 200, but when we look at our losses, we change it back to 20. So when you change it back to 20, right, you notice that the range becomes very narrow already. Okay, so what happens here is that you can actually trail your losses along this line, or even somewhere below this line, just below. And of course, as you keep on entering more trades, right, over here, right, you notice that this chart here, as you keep on entering more trades, okay, so 1, 2, 3 example, over here, right, you notice that when this line here, right, plots downwards, that is when your stop loss will be executed. Okay, so if you enter here, here, and here, right, you notice that maybe your last position or your last two positions, you may be taking some very small losses, but don't have to worry that much, because your initial trade and your initial few positions that you continue to scale in, they will be in the profits. It's just that when you're looking to continue to trade up the trend, sometimes it's very hard to understand or to identify where is the peak of the trend, right? The trend may just continue to keep going up if it's a very strong uptrend. So the idea here is that as it continues to go up, right, you keep your stop loss here using the 20 period Donchian channel. And when it starts to break this 20 period low, right, that is where all your initial entries, you exit at the same point. Okay, so let's say if you enter 4 trades, trade 1, 2, 3, 4, trade 1, 2, and 3 is making money because you entered very early and then you start to scale in. So trade 1, 2, and 3 is making money. Trade 4 is the latest entry that you go in because it started to create new highs, right? But this time you're not sure already because prices are starting to consolidate. It seems that it has already broke the 20 period low. So when it broke the 20 period low, that is when trade 1, 2, 3, 4, it exits all at this same level. Trade 1, 2, 3, probably you make money. Trade 4, you take a very small loss. So net, you still get you are still in the green. Okay, so that's one way you can use this to cut your losses. Okay. So this is what I have for you today. I hope it has been useful. But just to wrap things up, right, we have covered how we can identify trends using indicators. And of course, we have covered that we don't want to go opposite the direction of the trend. If it's an uptrend, we go for long entries. If it's a downtrend, we go for short entries. We covered where are the potential entry and exit setups. We talked about how you can scale in winners as well as how you can cut your losses. Of course, the key thing I want to highlight as always, every session is that risk management is still the key. Because if you don't practice the position size, right, if you don't practice to keep your losses to minimal, you won't have the longevity to trade long term. Okay, so let me see if there is any questions that I can answer. Just a moment. Okay, hello, are you placing sell or buy limit orders as pending orders? Are you waiting to have a bearish candle to enter? Yes, so Karim, usually when you are looking at trends, what we want to do is that you want to place orders. More often than not, we are looking to place orders. But of course, before the line is formed, sometimes it's very hard for you to gauge where is the new, because the moving average line is constantly changing, right? If it is an uptrend, it constantly goes up. If it's a downtrend, it constantly goes down. We don't have the exact level, but we can get a rough gauge of the level. Okay, but unless as you're monitoring the market, you notice that it is currently live right now, testing the resistance. There's some form of resistance that is in your downtrend, right? There is some form of a bearish price action. Then you think that that there is a high opportunity or high probability for you to profit from a short trade or sell trade right now, then you can enter a market order. Okay, so how do you know that is 340 points away? Okay, so I think you are referring to the slide on the position size on Tesla. So in the trading platform, it will actually show if you place your trade on the chart. If you drag Tesla, let's say to for our entry, I think earlier was 170. And the stop loss was 166.6. The deal ticket automatically, it will show you that is a 340 point distance. So you don't have to worry too much. Just make sure that in the chart as you place your orders, right, the levels are accurate. Okay, next question. For the stop loss, can I don't put and take profit? Okay, so I think this question is asking if we can exclude the take profit and just put in a stop loss. Okay, definitely yes, you can not put in the take profit level. But if you're not putting in a take profit level, what I recommend you is that for your stop loss, keep on adjusting it upwards rather than put in a initial stop loss level and keep it there forever. Okay, because if you are trading trend and if you don't have a take profit level, if you got it right, then you want to move the stop loss level up to make sure that you shift it to the break even level, you shift it to a level for it to lock in your profits. Okay, so that's how you can actually take small profits from the market as well. Okay, if not, I don't see any other questions. So I'll just very quickly take the next 2 minutes to highlight some of the resources that we have. So firstly, again, if you are joining me here today, I assume that you are interested in educational content such as webinars. So if you are new to us, right, just want to highlight that within the IG website, there is this place called the IG Academy. And within the IG Academy, there's this webinar library. Okay, the webinar library, we have a lot of past recordings from our previous sessions. They can be from our external guest speakers. They could be our market analysts, our in-house staff as well. It could be from my own sessions as well. So there's a lot of content here, free content for you to watch on demand. So just take note of that. And of course, this is the QR code for you to join our Telegram group. So if you are keen to receive on the go news, right, you can actually join this group, scan this QR code here. You will be able to join our Telegram group to read all this on the go news. And last but not least, I always, as per all my sessions, I always encourage you to provide me with some feedback as well. But of course, if you think it is useful for you, please just scan this QR code. It won't, I promise you, it is just a 1 minute feedback form. It is very short. So it's just 1 minute of your time. I will value your feedback so we know what kind of topics that you like. And of course, if you think that this is not useful or the timing is not good, let me know as well. And then we can see how we can work towards to provide a better experience for you viewers as well. Okay, if not, I apologize for overextending today's session. Right now it is 8:10. It has exceeded by 10 minutes, but I hope you don't mind. And I hope you find this session useful as well. So if not, then I will see you for the next webinar that's happening next week. And of course, for the month of March, every Wednesday, we also have sessions lined up. Just head on to our website and look at the upcoming webinars and seminars page. Okay. So if not, I thank everyone for joining me throughout the entire session, and I will see you guys for the next one. All right. So cheers and enjoy the rest of your evening, and of course your day if you're from other regions. Thank you.